Hey everyone, welcome back to Corporate Decoder, the place where we uncover today's SEC filings and find out if companies are actually telling us the future or just a fancy story. Today we're diving into a filing from Seritage Growth Properties. And let's just say there are some interesting shifts in how they're handling executive compensation as they navigate a plan of sale. Stick around as we decode what this really means for the company and its top brass. So, the earliest event reported in this document is the 21st of November 2025. This filing essentially lays out some important changes regarding the company's Chief Operating Officer, Eric Dynenberg. The main story here is about changes to Mr. Dynenberg's employment agreement. Think of it as a renegotiation of his pay and responsibilities in light of the company's ongoing plan of sale, meaning they are looking to sell the company or its assets. This phrase is key. When a company is executing a plan of sale, it means they are actively working towards selling the business or a significant part of it. This often leads to adjustments in executive contracts to reflect the new circumstances and to incentivize key personnel to stay through the transition. Instead of the previous arrangement, Mr. Dynenberg will now have a 6-month retention period. This period begins on the 16th of March 2026 and ends on the 15th of September 2026. This is a shorter period than what he would have had if his old contract had automatically renewed. The reason for this shorter period is likely tied to the uncertainty and timing of the sale process. The total compensation and benefits Mr. Dynenberg will get during this period, excluding something called an additional bonus, will be about 50% of what he would have earned if his previous contract had renewed for a full year. Basically, he is getting less overall. But it is structured to keep him focused on the sale through September 2026. His employment is set to end on the 15th of September 2026, unless they mutually agree to extend it, or if certain termination events happen sooner. Now, even though the overall package is reduced, his base salary and target bonus for the coming period are actually going up by 5%. This is a bit of a mixed message, but probably part of the effort to keep him motivated during these remaining months. He'll also receive a retention bonus of around $434,000. This bonus will be paid out in two parts, one on the 15th of July 2026 and the rest on the 15th of September 2026. The catch is he has to be actively employed and in good standing with the company on those dates to get the money. On top of that, if he is still with the company through the end of his retention period in September 2026, he gets a cash bonus of about $173,000 instead of some kind of stock award for his 2026 work. He'll also get a prorated bonus for the period from the 1st of January 2026 to the 15th of September 2026, amounting to about $245,000. The agreement also outlines what happens if his employment is terminated early, if the company fires him without a good reason, or if he quits for what is defined as good reason. He'll still get some payments. This includes any unpaid retention bonus, his full salary for the remaining part of the term, the prorated bonus, the 2026 cash bonus, and an extra lump sum equal to 1 year of his base salary. This is pretty standard severance protection, but it is good to see the details laid out. Interestingly, the filing also mentions that Matthew Fernand, the Chief Legal Officer and Corporate Secretary, has had his employment term extended for another year, starting the 16th of March 2026. This comes about because the board decided not to give notice that they were ending his current contract. So, while Mr. Dynenberg's role is being scaled back and defined by a shorter retention period related to the sale, Mr. Fernand's position is being secured for longer. This could suggest that legal oversight is seen as critical through the entirety of the sale process and beyond. Now, let's try to get a sense of the bigger picture here. Seritage Growth Properties is in the middle of a major transition plan of sale. This often means the company isn't investing heavily for long-term growth, but is instead focused on maximizing value for shareholders during the sale. The adjustments to Mr. Dynenberg's compensation reflect this: a shorter performance-based retention period to ensure continuity during the sale process, with some financial protections if things change unexpectedly. The increase in his salary and bonus, despite the reduced overall package, might be a strategic move to keep him highly motivated and focused on successfully closing the sale. The extension for Mr. Fernand signals a need for strong legal guidance, which is understandable during complex transactions like a sale of the entire company or its assets. It shows that the board values stability in key legal functions. What this filing doesn't give us is a lot of hard financial numbers for the current period. It is more about executive contracts and how they're adapting to the company's strategic direction. Normally, we'd be digging into revenue, profit, and balance sheet items. However, in this specific 8K filing, the focus is on an executive compensation update. Looking at the broader context, Real estate investment trusts like Seritage Growth Properties often undergo such strategic shifts. The success of the plan of sale will be the ultimate determinant of shareholder value. The compensation changes for Mr. Dynenberg seem designed to align his incentives with the successful completion of this plan. Are there risks? Absolutely. The biggest risk is the failure to execute the plan of sale at a favourable price or within a reasonable time frame. If the sale stalls or the terms are unfavourable, it could impact the company's financial health significantly. Opportunities, however, lie in a successful sale that returns substantial value to investors. In conclusion, this filing tells us that Seritage Growth Properties is actively managing its leadership team through a critical period of strategic transition. The executive compensation adjustments are a clear indicator of a company focused on getting a deal done. We'll be watching to see how this plan of sale unfolds and what it means for the company's future. What is your take on these executive contract changes and the company's strategic direction? Let us know in the comments below. If you found this deep dive helpful, please hit that like button and subscribe so you don't miss our future analyses. Don't forget to join our Discord community. Linked in the description for more discussions and insights. Thanks for watching, and we'll see you in the next decoded filing.